Why market crashes terrify investors? Market crashes are caused by fear, uncertainty, and panic selling. But every market crash has actually been an amazing opportunity to buy. So today we'll be talking about how crashes happen, how to stay calm, and how to use these crashes to your advantage. Have you ever panic sold a stock? Please comment below. Firstly, the psychological traps that cause panic selling. As you may know, investors aren't rational, they are emotional, and the market is triggered by psychological biases that lead to bad decisions. So, we have four main biases we're going to be talking about today: loss aversion, recency bias, herd mentality, and confirmation bias. Loss aversion leads people to believe that when they lose money, it outweighs any growth they've gained. For example, this can cause more panic as a decreasing number in their portfolio feels astronomically larger than when their portfolio is increasing. Recency bias states that when something happens, people believe that it will continue happening forever. So this can make people believe that stocks will continue to fall even when it is very unlikely and they start to rise again. Herd mentality, as you already know probably, is when everyone is selling, you feel like the right move is to sell. But sometimes you have to go against the herd and try and find the opportunities to buy when everyone is selling. And finally, we have confirmation bias. This is when watching negative news reinforces your fears and causes you to be more panicked. For example, if you sold tech stocks in 2020 thinking the market would keep crashing, you would feel like an idiot. Amazon, Apple, Microsoft did drop 30%, but recovered fast. The best investors learn to control their emotions. The market rewards patience, not panic. Market crashes aren't normal, is what most investors think, but they are. A bear market is just part of the market cycle. There's a bear market every 6 years on average, and they drop to 20 to 50%. But they only last 9 to 12 months and normally recover in at least 2 to 3 years. Normally, sometimes faster. For example, market dropped 50% in 2008, but it quickly recovered by the time, that's probably a good point where it recovered, probably 2012 or 13. So, what we can do to take advantage of this. Market crashes are actually buying opportunities. When the market crashes, all the stocks are on a discount. So, if you look for high-grade businesses and use value metrics and checking against their historical prices, you can find amazing deals. So, when you are looking, you should be looking for a business that has a strong track record and has good technologies and is not going to be faced with regulatory or technological replacement. You should also be looking if the business has a high PE or price to book ratio or PEG ratio, because you can find companies that are undervalued in comparison to either the market, their industry, or their previous historical prices. For example, Amazon, one of the greatest companies of all time, could have been bought at nearly half price in 2020 at 1,700. Now it is over 3,000 once again. And Apple, very similar, one of the greatest track records of most companies in the stock market, over $1 trillion of valuation, could have been bought at $60 in 2020, but now it's well over 150. Here are the 3 steps you can take to make sure you can take advantage of these opportunities. 1. Outline companies that, if they were more fairly priced, you would want to own them. This can be Apple or tech or healthcare, some of the best companies in the world that you would love to be able to invest in, but you don't have the margin of safety to do so. So set up a stock screener or Google Alerts to tell you when the price goes below a certain threshold. Then you can relook at your research and understand if this is a short-term event and people are overestimating, or maybe you should wait, see how it goes, because this could be a long-term determiner. For example, you wouldn't have wanted to invest in Kodak at the release of digital cameras, obviously. Secondly, you can dollar cost average, so spread your investments over a wide period of time. This will decrease the chance that you are buying at the top and increase the chance that you are buying at the bottom. So it will average out the rough stock price that you're buying at for the general market. Or you can follow Buffett's rule to buy when others are fearful, because market fear makes a discount. And if you can buy a great stock for 50% off, you will win in the long term. But there are some costly mistakes you must avoid when you're going into a market crash. So, obviously, as we've talked about before, we want to avoid panic selling. Obviously, you can't time the market, as this is impossible to do. So, invest gradually as stocks are continuing to rise. You should never ignore the fundamentals of a company. A stock, no matter how cheap it is, can be overvalued. And don't hold a bad company too long. Some companies never recover. Maybe it's technology, maybe it's the change in customer preferences. But some companies, they are better to be left alone. Market crashes aren't a time to panic. They are time to invest smartly. Every billionaire takes advantage of fear in the market, and you can too. Keep watching. Keep a watch list of great stocks. Invest consistently, even during downturns, and think long term. Market crashes are temporary, but wealth building is over decades. Thanks for watching, and I hope you found value in this. Subscribe if you did, and have a great day.